Hey guys, spring has definitely sprung. I'm very excited. It's like t-shirt weather again and just a great time of year. I love the spring. There's this tree outside, actually right outside my office here. This actually is my outside patio in the office. It's really cool, so I can go out there and do phone calls and fall asleep. No, but this is tree, check it out. Anyway, so I love the spring, and now I forgot what I was going to talk about today. No, I know exactly what I was going to talk about. I was going to give you guys an update on the market here. We've got some pretty cool things happening all of a sudden. Also, I've been up to a lot of different things over the past few days or so. We finished up a new gap trading course last week or 2 weeks ago. That's just been an unbelievable success. People are loving trading the gap with my indicator and my scanner and the courses that came along with it. And now I'm working on, just a heads up, I'm just starting to work on a brand new course. It's basically like a little bit more of an introduction course. I don't want to call it a beginner's course, but it's kind of introducing people to stock markets and options and various strategies like that. It's going to be really cool. And I'm actually going to write a book as well. So a lot of stuff going on. But anyway, enough about that. Let's have a look at the market. A couple things are happening here that I think are noteworthy. We've had a stock market last week that, despite really a lot of stuff that was thrown at this tape, really didn't manage to sell off so significantly. I think there's one key point that people are missing. So let me show you guys a couple things here and make 1 or 2 points.
Okay, so let's have a look at a couple of charts. And if you might remember, if you watched last Friday's video, you can link to it here. What I talked about there was a warning sign that we had in the broader stock market earlier last week, and basically that was a sign from a swing trading, like a near-term perspective, to sort of take some risk off, maybe get out of some long positions. At the same time, however, the market really has so far failed to materially break lower. If you really think about it, all the news that we've had last Friday with the healthcare bill not being able to get passed, that's a lot of potentially negative news that a lot of folks out there have been saying could really break the market. Now, we're only a couple days into this news now, or at least a couple trading days, or I guess about a day and a half of trading into that. So a lot can still happen, but if you kind of look at a couple of things I'm going to show you guys here, it's quite amazing that the market actually is holding up as well as it does. And to me, well, the point I'm trying to make here is that there's actually a lot of underlying economic data that's been a lot better over the past 4, 5, 6 months, and particularly on a year-over-year comparison, that data has been getting better and better. Same thing for from a corporate top and bottom line perspective, data's been getting a lot better. So these 12-month comparisons are getting much better. Now, again, if that sounds too complicated for you, forget about it. Let's have a look at a chart. If you look at the Russell 3000, it's holding on to support right here. Right now, you can see we tried to attempt to break back below support from last week, I guess, and on Monday, the 27th of March, and we managed to bounce right back. Now, again, one day does not make a trend, but it's still, considering all the news flow, all the potentially negative news flow that we've had, it's still, to me, quite remarkable that we're holding up as well as we are. Now, not everything's holding up. The financials obviously had quite a drawdown, but look at the financials. This is the XLF. It represents the financial sector of the S&P 500. And if you look at the chart here, you can see that we are, yes, we've certainly broken below a whole bunch of stuff. And in percentage terms, I'm going to quickly do that math for you. In percentage terms, we had a drawdown of roughly, let's call it 9-ish%. All we've done basically is mean we're back to where we were in sort of mid-January, excuse me. So not a whole lot of stuff here breaking down. If you look at some single name place, or actually if you look at the BKX, the banking index, you can see we're actually seeing some exhaustion selling take place here with the past few days. These long candles here, to me that's quite significant. Also look at biotech. Lastly, quick look at biotech. Biotech, largely speaking, remains essentially stuck in a range which I would define as something like this. But if you look at this a little bit more closely, you can see we actually had on Monday, the 27th of March, what I consider quite a significant outside reversal day. That's this day right here. Okay, we actually had one take place here in January as well. So these are quite powerful, and you can see what the January January outside of Russell did, it led to a nice rally. So maybe we're not ready to pop. So again, I just want to give you guys a bit of context, let you guys know that a lot of people, in my opinion, got very, very negative over the past week and a half or so. Yes, the markets have certainly corrected somewhat, but they really are holding on quite well. I would say very well considering what's out there. So I'm actually looking to be a little bit more of a buyer here. See if these levels can hold. If they're not, we'll get back out. But so far so good.